Hello friends, welcome to our channel Accounts and Finance with FARSK. This is our video on the fifth part on the series on the financial accounting ratios, profitability ratios 2 of 2. Hope you will like, share and subscribe our channel. Profitability ratios 2 of 2, the final part. The types of profitability ratios: gross profit, operating profit, net profit, return on capital, return on assets and equity, cash flow return on investments, DuPont analysis return. The first three ratios we have already discussed in our previous video, and now we will proceed with the balance of the ratio types for profitability. Return on assets and equity. Return on assets, the measure of a company's net income divided by its assets. Through ROA, management analysts and investors can gauge the corporation's ability to use their assets efficiently to generate more profit. Formula: net profit divided by total assets. Ideal over 5%, excellent 20%. Return on equity, the measure of a company's net income divided by its shareholders' equity. ROE is a gauge of corporation's profitability and how efficiently it is in generating income and growth. Formula: net income divided by shareholders' equity. Shareholders' equity formula: total assets minus total liabilities. Ideal, the higher the better. Return on capital and or return on invested capital. Calculated normally on percentage basis, measures of how effectively a company uses the money that is borrowed or owned, invested in its operations. Return on invested capital, that is ROIC, is one of the most important ratios to consider when you are thinking about investing in a company. It's a ratio that measures how much money a business is able to generate on the capital employed. It's typically reported in the fundamental section of your favorite online stock screener. However, you can also calculate it from the company's financial statements. Formula: net earnings divided by total capital into 100. Ideal 15%. Cash flow return on investment, or simply CFROI, is a metric used to evaluate the performance of an investment. It measures the cash that an investment generates over a period of time divided by the initial investment. In order to calculate, you need three things: the cash flows from the investment, the time frame, and the initial investment amount. The cash flows can be inflows, that is revenue, or outflows, that is expenses. For investments that generate revenue such as rental property, CFR will be positive. For investments that have expenses such as stock trading, CFR will be negative. The time frame is important because it determines how much time you have to generate cash flows. A shorter time frame means you need to generate more cash flow per month to achieve a higher CFR. A longer time frame gives you more leeway and may result in a lower CFR. The initial investment amount is straightforward. It's how much money you put into the investment at the start. Once you have these three things, calculating CFR is simple. Just divide the total cash flow by the initial investment amount. Ideal 7% or greater is considered a good ROI. DuPont analysis return, derived from DuPont company that began using this formula in 1920s. Initially, they developed it for their own use, but as the time passes by, now it is used by many firms to evaluate how effectively their assets are used. It measures the combined effects of profit margins and asset turnover. DuPont expression that shows a company's return on equity ROE is a measure of the rate of return to stockholders. ROE can be represented as a product of three other ratios: profitability, which is measured by profit margin; asset efficiency, which is measured by the total assets turnover; and equity multiplier, that measures a company's financial leverage or the extent to which it finances through its assets through debt, calculated by dividing the company's total assets by shareholders' equity. The equity multiplier provides insight into the proportion of a company's assets that are financed by debt as opposed to equity. Therefore arrives a formula: net profit divided by sales multiplied by sales divided by average total assets multiplied by average total assets divided by average equity, which is equal to net profit divided by equity. Ideal, the higher the better, of course. Well, that's it for today. Hope you like our video. For more videos, please do not forget to like, share and subscribe our channel, Accounts and Finance with FARSK. Thank you. Have a great day.